time. I do want to ask, what are the downsides of the FHA and or the Fannie or Freddie that people should be aware of?
Great question. So every loan has its own, unique characteristics. FHA is a government-backed loan, just like Fannie and Freddie, but it is designed historically for folks with a lower down payment and perhaps some credit challenges. It's a great mortgage product for someone who does not have perfect credit because they don't penalize you for the interest rate nearly as much as a conforming loan through Fannie Mae. So if you're putting down the minimum of 3% through Fannie Mae and you have perfect credit, you're getting almost the best rate. Maybe not quite. If you put down 30%, you get a little better rate, but you get a very good rate. Unfortunately, if you have a 699 credit score and you're putting down 3%, they're going to crush you. Your rate's going to be 1% to 1.5% higher. FHA, on the other hand, the rate is not significantly higher than the going rate. The challenge with FHA loans is twofold. There are additional costs. So you pay an upfront mortgage insurance premium, which could be on $1 million mortgage. It could be, closer to 20,000 than 10. You also have monthly private mortgage insurance. Anytime you put down less than 20%, whether it be a conforming Fannie Mae, Freddie Mac loan, or whether it's an FHA loan, you will pay PMI on top of your mortgage payment. The PMI for the FHA loans, it is underwritten similarly to a loan. So the worse your credit, the more it costs you. And typically, when you get down to some of the lower credit scores, something below 740 and above 620, the lower you go, the more expensive the PMI gets. In some cases, FHA PMI can be $400 or $500 a month more expensive than a Fannie Mae conforming loan. So we're going to look at both sides of that equation. If your rate is higher for Fannie Mae, but your PMI is so expensive that it offsets and negates that, you may be better off with the higher rate through Fannie Mae. Also, the PMI on the FHA loans does not go away when you create equity years down the road. While that used to be the case, it no longer is unless you put down a huge down payment. So we're talking minimum down payment. Your PMI is permanent. The only way out of it is to sell the home or refinance to a Fannie Mae conforming mortgage.
Got it.
The other downside to the FHA loan is they make you finance that upfront fee, that number that on $1 million mortgage might be closer to $20,000. They don't typically get that money at closing. They typically add that to your loan amount, making it even harder for you to get equity, and you pay interest on it, which makes it cost a lot more than if it were $18,000. You're probably paying $50,000 in interest on it over 30 years. So it's a much more expensive loan product. It's a great product for those people who can't fit into a Fannie Mae or a Freddie Mac loan. So we do have it in our arsenal, but we'd only recommend it if you had to take it. They do have looser debt ratio requirements. So let's say I meet a couple of people who qualify for a $1.3 million mortgage through Fannie Mae. They're going to qualify for a $1.5 million mortgage through FHA.
Okay.
You need to stretch it out. Sometimes you give someone plan A and they say plan A is not enough. You've always got plan B. That's what I call FHA, plan B.
And